I see the market as an interesting place, right? So we've seen the last several years all the money flowing into index funds, passively managed funds, which that's okay. I think there's a certain place for that in a portfolio. But now is the time, if there ever was a time for active managers to shine, this is it. So when you talk about rotating out of healthcare, I don't know, most of our clients don't rotate out of sectors they're going to overweight or underweight. And what stocks are you picking in those spaces that are going to outperform in the market that we see going forward? I think the economy is doing well. I've sat on this panel and heard people tell me it's doomsday, but we continue to see the resilience in this market and the resilience in the consumer that continues to allow this market to rise. Maybe it doesn't go as high as you know, or we're not seeing the rise in rate as much as we saw in 2018, but we are going to continue to slowly tick higher unless we see some catastrophic things happen in the marketplace right now.
All right, Josh, you want to take aim at these IPOs, which both are surging off the open, Pinterest and Zoom, excuse me.
Well, I think it's great that you can do IPOs. I think it's great that people on the street are talking about IPOs. There's a lot of investor enthusiasm. I've been reticent to get involved. I did not like Lyft, and I was pretty clear about why. I probably won't get involved in either of these two. But I think it's important that when you look at what's happening with underwritings in general, and you say to yourself, where are all these deals occurring? They're not only tech. We happen to be talking about two tech names today, but Levi's was a huge deal, very big deal. So the average IPO this year is up 20% from where it was offered, which is phenomenal. Lyft obviously pulls that average down.
Zoom pulling it up.
Right. The average tech IPO, though, is up 34%. So, yeah, there's a lot of enthusiasm. And by the way, I do think that there's a corollary to what's happening with healthcare versus tech right now to what we saw 20 years ago. The last time you saw the healthcare sector trail the overall market by 17 percentage points, which is a huge differential, was in the late 90s. And what was going on back then? People were only interested in growth companies, would not buy anything else. Buffett didn't know what he was doing anymore suddenly. And you saw healthcare stocks completely neglected, left by the wayside. I do think you're seeing a little bit of an echo of that, so let's keep an eye on it. If everyone only wants growth, that does create opportunities for people who are willing to look at drug discovery companies, at biotech, at medical devices.
So Kate Moore, does better economic data than expected, as Steve Weiss said, earnings better than some anticipated a few weeks ago, is that now a license to buy stocks? I mean,
well, I think there are a couple
the fears
things.
Are out of the way now?
Yeah. I think there are
look
a
at
couple
retail number today. Best retail number since 17.
That's right. The labor market's in good shape. We have lots of good macro data kind of supporting a slow but still expanding global economy. I think there are two things that I'm really watching, though. The first is the earnings revisions. Now, this has been, awful over the last 4 months. The downward revisions relative to upward revisions were at some of the worst levels we've experienced over the last 10 years. That seems to be bottoming out, especially when you look at the 1-month earnings revision ratios. So we're watching that really closely across all sectors. I would note that healthcare has the best earnings revision ratio of any sector globally, and particularly in the U.S. So this is a disconnect between the fundamentals and the fear of what may happen in terms of change in policy. The other thing I'm watching really closely is fund flows. And we've seen huge amounts of redemptions from equity fund flows year to date. We keep on talking about this, but when you annualize this data, both as a percentage of assets under management as well as kind of in absolute terms, these are phenomenally large numbers. I don't think people have been really excited about this rally. I think the pain trade is a little bit higher in the near term, even if we're going to have more volatility throughout the second quarter.